As is often the case, the main macroeconomic headlines of the coming week are likely to be written on the other side of the Atlantic, as we get the latest job openings and inflation data from America, the world's largest economy. On Wednesday, the 8th of December, economists, central bankers, and investors were going to look at the latest job openings and labour turnover survey, or JOLTS for short. This monthly study has been running since 2000, and right now US job openings stand at 10.4 million, just short of July's all-time high of 11.1 million. Now that openings figure easily outstrips the official unemployment figure of 7.4 million to suggest the US economy is indeed in rude health. So watch the trend in the openings figure, but also look at the quit rate. A record number of Americans left their job in September, some 3% of the total non-farm labour force. That suggests workers are confident about finding a new job and presumably getting themselves a pay rise in the process. Although it is possible some workers could be packing in because they're retiring, they don't want to travel because of COVID-19, or even because they think rising stock markets and cryptocurrency prices mean that day trading is a better option, although history clearly suggests that isn't always the case. Now, either way, the high quit rate suggests that the jobs market is hot and that American workers will be demanding higher wages, something that central bankers will be noting carefully with their eye on inflation. And speaking of inflation, we get the latest measure of increases in the cost of living stateside on Friday the 10th of December. Last time around, inflation, as measured by the Consumer Price Index, was 6.2%, well ahead of the Federal Reserve's 2% target, and actually the fastest rate of increase since 1990. Now, the Fed is tapering quantitative easing at the rate of $15 billion a month, but it's still adding to QE and keeping interest rates at record lows. So it'll be interesting to see if the latest inflation figure influences the central bank's thinking on what is still currently ultra-loose monetary policy. Equally, the new COVID variant may tempt it to leave alone next time it meets. You just never know. Now, back home, we have a busy slate of corporate news releases, including results, trading updates, our analyst meetings from 9 FTSE 100 firms, as well as Royal Dutch Shell shareholder meeting on the 10th, when the oil major will seek investor approval for shifting its tax domicile to the UK, moving its HQ to the UK, changing its name to just Shell, and scrapping its dual share structure, with London hosting the lead quote. Now, other events which may be worthy of note include the following, although always remember these dates could yet be subject to last-minute change. Chemicals firm Victrex on Monday the 6th of December, Ferguson, British American Tobacco, Ashted, Informa, Avon Protection and Babcock on the 7th, Stagecoach, TUI and SSP on the 8th, Rolls-Royce, Ocado, DS Smith, Dr. Martens, Moonpig, Watches of Switzerland and Balfour Beatty on the 9th, before Fraser's, Yellowcake and that Shell shareholder meeting wrap up the week on Friday the 10th of December. But for all of that activity, the company which could just cause the biggest fuss in the week ahead is Berkeley Group. The high-end house builder is due to report its first half results on Wednesday the 8th of December. Now, Berkeley shares stand around 5% lower than they did a year ago, despite management's ambitious plans for housing completions, profits, and cash returns investors by 2025, let alone the company's lofty operating margins and net cash balance sheet. Now, this share price weakness may be down to investor concerns over the direction of the UK housing market should interest rates finally start to rise, the impact upon Berkeley's profit margins of its drive to be carbon neutral by 2030, plus the availability and rising cost of materials and qualified staff, and also what the lasting impact of COVID-19 might be, if any, upon demand for metropolitan dwellings, given the company's historic focus on London and the South East. Now, no doubt long-standing Chief Executive Rob Perrins will address all of these issues alongside the results for the 6 months at the end of October. Analysts and investors will also study these first half results from the perspective of the guidance for both full-year profits and capital returns provided alongside June's full-year figures. Now, in terms of profit, Berkeley still expects to make around £500 million a year in pre-tax profit each year out to April 2025. Berkeley made £231 million pre-tax in the first half of its last financial year, on the way to making £518 million overall in the 12 months to April 2021. Berkeley also intends to return £280 million a year to shareholders each and every year through to September 2025 via a mix of dividends and share buybacks. Now, in the first half of last year, Berkeley paid out £134 million in dividends, or 107p a share, and bought back £37 million worth of stock. Now, there's been very little by way of buyback activity in the first half of this year, but Berkeley did revive a plan to return additional cash to shareholders to top up the planned regular returns. Out of a £455 million surplus cash position, to use management's description, Berkeley returned £228 million via a B share scheme. Add that to the regular returns, and the first half dividend paid in September was a bumper 371 pence a share. The other £227 million in surplus cash will go on land acquisition, as Berkeley looks to add to its land bank of 63,000 homes. And therefore, as a final point, analysts will no doubt look for comments on volumes, pricing, and the order book in terms of just day-to-day trading. Last year, Berkeley sold 2,825 homes, with an average selling price of £770,000, while the order book stood at a robust £1.7 billion at the time of the September trading update, broadly unchanged from the end of the financial year. Berkeley's got a target of delivering 5,500 homes by 2025, and a big source of the uplift will be the firm's 29 brownfield regeneration sites, 23 of which were already in production as of April. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.